Good afternoon. It's the Wall Street crossover show sponsored by Admiral Markets with Darren Cinder and their market commentator. How are you this afternoon?
Yes, very well, thank you, Zach.
Right, sort of again relatively calm. There's no blood on the streets, for at least for now. Anything which sort of on the macro view taking your fancy?
Well,
or
I think China, in the absence of any further news on Greece, China has taken the lead, really.
Yeah.
Quite a bit of data out of there this morning, and we'll come on to that in a moment. But yeah, as you say, quiet, but perhaps a bit too quiet, really. It makes one suspicious that things must be rumbling on behind the scenes. But if we move on to
well, no, because we had the debt relief concept. The debt relief is probably the last thing that. That's really is the capitulation part of the whole cycle. The IMF suggesting that Greece needs debt relief, or would. That's what they might be prepared to do.
Well, they seem to think that without that, the Greeks won't be able to go forward. And I have to agree with them. I mean, the debt to GDP ratio is going to go north of 200% potentially with a third bailout round. That's so we'll be approaching 400 billion euros. How on earth will that economy ever pay that money back? If they had 100 years to do it with the interest on top, I doubt it's possible. So we should have to wait and see.
Right. Okay. Well, let's see what we've got on the data this morning.
Okay. Well, as I say, China hogging the limelight early doors before the European Open, and a couple of numbers were out, but I've decided to focus on the GDP for the second quarter in 2015. This is the year-on-year change, and miraculously, it's come in at dead on 7%, exactly the level that. It's always
there. I mean, presumably next Q3, Q4 will be 7% as well. Is that right?
Well.
That would be more of a challenge, I think, than.
Well, yeah. I mean, if one was charitable, you'd say that they've moved heaven and earth to massage the numbers to 7%. The forecast around the street was between 6.8 and 6.9%. The prior read was magically 7%. I think people are starting to question the validity of Chinese data again. We saw retail sales up supposedly 10%. 10.1%, I believe, year on year. Again, that all seems a little bit too good to be true, given the near panicking moves that the Bank of China's made People's Bank of China's made in terms of monetary loosening recently. But we shall see. Anyway, 7% was the headline figure, so that's what we've got to take into account. And then moving on to things a bit closer to home, Mr. Carney, of course, you'll recall yesterday suggested that a rate rise in the UK was moving ever closer. We questioned whether the data would support that, and today we've got our answer. The answer is no. UK average earnings for May were better. Yes, they're up by 2.8%, but that was below the forecast of 3%, and exactly in line with the prior read of 2.8%. So we're not seeing growth in wages on a month-to-month basis.
Although I suppose compared to inflation, which is 0, that is quite let's say it's 3% above inflation.
Yeah, that's true. I suppose in that regard, it is above inflation, but it's not that steepening curve that they would like to see as a pretext to raise rates. Yeah. And then hand in hand with that came the unemployment figures for May, and we actually had a rise, 5.6%. UK unemployment rate versus a forecast of 5.5 and the prior read of 5.5%, and that was up for the first time in 2 years. So that's not what George Osborne or Mark Carney we want to have read today.
Which came in after the election, so that was all right.
And then in terms of European inflation numbers, we've talked about these over several days, and today we had the CPI, Consumer Price Index, for June in France, the year-on-year measure, minus 0.1%, completely polar opposite to the forecast of growth of plus 0.1%, and miles away, kilometres away from the prior plus 0.2%. So obviously the ECB is predominantly focused on Athens at the moment, but they've got plenty of other problems to contend with. QE doesn't seem to be producing the goods at the moment as we sort of into a full 3 months of it.
Well, I suppose the other thing to think is what it would have been like without it.
That's probably a very diplomatic way to look at things, Jack. Thank you very much for coming.